Did you know different lenders can offer very different mortgage amounts, even for the exact same person? If you're a first time buyer and your thought was, let me go to my bank, they know me, hold on. That's actually one of the most common mistakes that I see. Because at the end of the day, there are restrictions, there are criteria. Let me explain. Now, with some lenders, they will allow certain things and some lenders won't. Now, if you go to your bank, which is normally one of the high street banks, high street lender, they can afford to be a lot stricter with their borrowing because they get so many mortgage applications. But if you go to other lenders, that include some of the smaller building societies, they are a lot more flexible. And this is what you need to consider. The other thing is, them knowing you inside and out isn't always a good thing. I mean, to be honest, the amount of first time buyers who've come to me and either got, worst case scenario, a decline from their current account lender. I'll call it current account lender, but you know, the lender who they have a current account with. Or they've been told that they have to put more in as a deposit, or they won't lend them as much as they're originally going to ask for. Now, it really does depend on your criteria. So when I personally go through it with my clients, I always use a system that actually looks at multiple lenders and we can borrow different amounts depending on who the lender is. And you might think that's just for the self-employed or just for people on benefits, but no, it's for the employed as well. I'll give you an example. There's a lender out there that will only use your bonus if you've got 2 years track record. Now, it doesn't matter whether you get your bonuses paid monthly, weekly, annually, quarterly, they have to have 2 years worth. Now, there's another lender that needs 2 examples of your bonus. Now, that, if you've been there, say, a year and a half and you get an annual bonus, the first year, probably because of probation, would have been prorated, and then the second year you'd have got it. Now, you haven't been there 2 years, but you've got 2 bonuses, so they will allow it. They'll do the average of the 2 bonuses, but you still get it included. Whereas in the first scenario, because they hadn't have been there 2 years, they wouldn't have not even taken one bonus, they'd have completely ignored it. Another thing is commission. Now, some lenders will take, if they know, if you can show a track record of having regular commission, even if it doesn't in your contract say in the words guaranteed commission, but you've got a track record, i.e., you've had it for 6 months, 12 months, whatever it is, they will allow that. Some will allow 50% of the commission, some 75, some the whole 100. But depending on what you do for a living, depending on how you get paid, there is a lender that wants to work with you. And the other thing is, which not a lot of people know, is it depends on the time of the month as well. It's quite unusual, but there are some lenders that have a quota that they have to meet of mortgages. If they actually meet them by the middle of the month, for example, then they get stricter towards the end of the month because they haven't hired enough staff to go through the volumes that they're going through. They've already met their target for the month. The shareholders are happy. They're going to stop because there's no point in hiring and training a whole new set of staff just because the volumes have gone up, because you can't guarantee it next month. So they have a set amount of people that they know they can always have enough work for. And if it goes above that, then they make things changes in order to work with that. Now, the next thing to be aware of, so when you're talking about employed, there are some lenders that will take you day one. There are some lenders that won't, that need you to be out of your probation. There are some lenders, you know, that want you to get paid monthly. There are some will accept if it's 4 weekly. There are so many different criterias just for the employed, let alone the self-employed. When it comes to the self-employed, there are some lenders that will take you an average over the 2 years. Some it will be an average over the 3 years. Some it will be the latest year as long as it's higher. Some will be the latest year as long as it's lower. Some will accept the latest year as long as it's not more than a 20% increase of the previous year. There's a lot going on, and depending on your situation, depends on which criteria, which lender you want to use. And don't get me started about benefits. I mean, some will take all of the benefits across the board, some will only take PIP, some will take universal credit, but you have to take the housing element out. There's a lender that you don't have to take anything out. There's a lender that, as long as it get paid into your bank account, it doesn't matter if there's more than one name on the award letter. There are so many different variations. And then there's the mortgage products. I always talk about the different types of mortgages because, you know, I love a quirky mortgage, but you've got the joint borrower sole proprietor. Not every single bank does that. There are different criteria there. You've got the income boost. Not everybody does that. You've got the professional mortgage that has higher multiples. Not everybody does that. Oh, and watch the higher multiples one. I saw a mortgage for 7 times salary the other day, and then when I actually rang up the lender and asked for the detail, I said, is it just straight 7 times the salary because that's what you're promoting? And they said, oh, there is an asterisk by it, because what they actually mean is, yes, it starts off 7 times your salary, but then when you actually go to do the decision in principle, and I've got another video explaining what that is, what actually happens is they have an affordability calculator in the background, like a cost of living calculator, and they put that in to work out what they think roughly your outgoings would be. And then that's for the decision in principle stage. So that's the initial stage. And then when you do a full mortgage application, of course you have to put all your outstanding credit and everything, and they can offer you an even lower amount. So you've wasted your time on this 7 times lender, and then because of your debt, and then some, depending on your debt to income ratio, so that's how much you earn compared to how much debt you've got, they may offer you half of what they normally offer you, or they may offer you nothing at all. So it really, really does depend. And then depending on your property that you're buying, some banks love certain properties and some don't want to touch them with a barge pole. Like, for example, you may do the calculator and work out you can afford X amount, but then they're not interested in shared ownership, or they're not interested in flats, or they're not interested in converted flats, or they're not interested in enlisted buildings. Honestly, you could find a property that you love, like a cottage. This happened with one of my clients, and she already had a mortgage in principle all set up. She had the affordability, everything was right, but they wouldn't accept her property. So then she came to me and I found her a mortgage that worked with that property. So honestly, when I say, did you know different lenders can offer very different mortgage amounts? I'm not kidding. So what I would like you to do as a call to action is contact me if you need help understanding how this all works. Check out more of my videos. There are quite a lot on there. And consider going to the workshop. So the workshop I keep on talking about is called the Get Mortgage Ready First Time Buyer Mortgage Workshop. The first part of it is about getting mortgage ready, and this is basically what I've been talking about: preparing yourself for the lenders, knowing what the lenders are going to ask, because you don't know what you don't know. So that's why it's always good to go to a mortgage advisor. Thank you.